So, for a while now, things have been pretty quiet in Tokyo's office market, since the pandemic. But that is all changing, and it's changing in a big way. For anyone keeping an eye on Japan's real estate market, this is a really big deal. We're going to break down exactly what's behind this shift.
And really, the whole story starts with just one number: less than 2%. Seriously, this one little figure is what has all the analysts talking. It's telling us the market has turned a major corner.
Okay, so what's the deal with this number? What does it actually mean? Well, it's what we call the potential vacancy rate. And think of it this way. It's not just looking at offices that are empty right now. It's also counting the ones we know are going to be available pretty soon. The fact that this number has dropped so low, that's a huge signal that the market is shifting gears.
And what it's signaling is a real full-scale recovery. This isn't just some temporary blip on the radar. Nope, this is a fundamental shift, and it's being held up by three really strong interconnected pillars. We're going to break down each one for you.
All right, so here's the game plan. First, we'll get a quick overview of Tokyo's comeback. Then, we're going to dive deep into those three key factors: vacancy, rents, and new supply. And we'll wrap it all up by looking at what this all means for you, the investor. All right, first up, let's talk about our first pillar, the incredible demand for office space. It's so strong, it's making vacancies just vanish across the city. Okay, think of this chart as a thermometer for the market's health. You see those two bars? The immediately available vacancy is already way down, under 1%. But check this out. Even the potential vacancy, that's the space that's about to open up, is hovering near 2%. What does that tell you? It tells you that companies are so hungry for space, they're basically soaking it up the second it becomes available.
So here's the bottom line. When good office space gets this hard to find, the power completely shifts. We are now officially in what's known as a landlords market. The building owners, they've got the upper hand in pretty much every negotiation.
It wasn't always a sure thing that we'd get here. For a while, a lot of market watchers were pretty nervous about one specific risk, something called secondary vacancy.
So what is that exactly? It's pretty simple, actually. Imagine a big company moves into a brand new shiny skyscraper. Well, what happens to the huge empty space they left behind in their old building? That's secondary vacancy. The fear was that we'd see a wave of these moves and end up with a flood of older, empty office buildings.
But that's just not what happened. And this part of the story is fantastic because it shows just how strong the market's foundation really is. Demand from other growing companies has been so incredibly strong that these older spaces are getting snapped up almost right away. That whole risk, poof, gone.
Okay, that brings us right to our second pillar. And you can probably guess where this is going. When demand is sky high and supply is tight, what happens next? Yep, prices go up. And that is exactly what we are seeing with rents. Now, this rent recovery didn't happen all at once. It kind of came in two waves. At first, there was this polarization, you could call it. Only the absolute newest, greenest, most high-tech buildings were seeing their rents go up. But now, all those prime spots are basically full. So that huge demand is spilling over, and it's starting to lift the rents for all sorts of other well-maintained buildings across the board. The good news is spreading. And get this isn't just a flash in the pan. We're talking about more than 20 consecutive months where average asking rents have been higher than the year before. Think about that. Yeah, that long of a streak, that tells you everything you need to know. For anyone watching this market, this is the proof that the recovery is for real. It has legs. This is a stable, sustained trend, and it points to continued upward pressure on rental income for a while to come.
Okay, and that leads us perfectly into our third and final pillar, the thing that really solidifies the outlook for the next few years. And that is the limited pipeline of new office buildings.
It's funny because not too long ago, a lot of investors were really worried about something they called the 2025 problem. The idea was that this huge wave of new office construction was set to finish around 2025, and it was going to flood the market, causing rents to crash.
Well, you can pretty much forget about that. Those fears have all but vanished. Why? Because of construction delays and changes to development plans. That massive flood of new supply people were scared of, it's just not going to happen. The pipeline for the next couple of years looks way more moderate and manageable. So let's just put the whole puzzle together. You've got this super strong, sustained demand. That was pillar number 1. And you combine that with a limited amount of new supply. Pillar number 3. The result is a simple but really powerful equation. Vacancy rates stay low, and that keeps pushing rents up. Okay, so we've established the market is strong, it's recovering, it's healthy. So what does this actually mean for you if you're an investor looking at Tokyo office space? What's the right move now?
Here's the most important thing to get. Even though the market is looking really good, the old rules of the game don't quite apply anymore. Just owning a building in a good location isn't enough to guarantee success. The very definition of what makes a prime property is changing.
So, what are the new keys to winning? Well, first, can your building actually accommodate hybrid work with flexible spaces? Second, does it have top-notch environmental credentials? We're talking ESG, ZEB, or Zero Energy Building certifications. These are the things that make a building a chosen destination for the best tenants, the ones who are willing to pay more.
And this really says it all. Even with these new rules, the fundamental outlook is very positive. The right kind of office building in Tokyo, one that checks these new boxes, offers this incredible potential for both steady, stable cash flow and future growth and value.
So let's wrap this up with the main takeaway. It's simple. Driven by vanishing vacancy, rising rents, and a limited supply pipeline, the Tokyo office market has finally moved past all that post-pandemic uncertainty. We are now in a genuine, full-scale recovery cycle. The tide has definitely turned. The big picture, the macro conditions are looking great for landlords and investors. So the final question really isn't about whether the market is good, it is. The real question is for you. Is your investment strategy built to win not just today, but in the office market of tomorrow?